Everybody. So let's start with the IS 16 property, plant, and equipment. Okay. So firstly, we all need to know about what is property, plant, and equipment. So IS 16 applies to all property, plant, and equipment. What comes under the heading of property, plant, and equipment? It could be, these are all sort of non-current assets such as buildings, such as machinery, such as land, equipment, as mentioned. Okay. So, property, plant, and equipment are the tangible assets. They are the tangible assets which we can see, which we can feel, which we can touch. And the tangible assets that are held for use, that are held for use in the production or supply of goods or services for rental to others or for administration purposes expected to be used during more than one accounting period. Or if we want to know the definition of non-current assets, what it is, non-current assets, resources controlled by an entity for more than one accounting period, and it is expected economic benefits economic benefits will flow to entity. Okay. So what does that mean? Non-current assets are the resources. They didn't use the word own. They use the word control because of the uh, fact that entities do get the assets on lease as well. So that's why they use the word controlled rather than owned. So by an entity for more than one accounting period, that means more than 1 year, and it is expected that economic benefits will flow to the entity. Examples of it: buildings, machinery, land, equipment, etc. As we discussed. Okay. Now, IS 16 does not apply to property, plant, and equipment which are classified as held for sale, which we will look at in detail in IFRS 5. Biological assets, which relates to agricultural activity other than bearer plants, which we will study in IS 41 in detail. Okay. Now, what's the recognition criteria? What's the recognition criteria of property, plant, and equipment? An item of property, plant, and equipment is recognized when one, first thing, it is probable that future economic benefits associated with the asset will flow to the entity. Number two, the cost of the asset to the entity can be measured reliably. When these two conditions are met, then we can recognize the asset and uh, we will recognize the asset and how it will be recognized. Well, asset debit, bank or cash will be credit. right? So, so far, so good. I hope you get it till here. Now, asset versus expense. Uh, in determining whether an item of expenditure should be recognized in the cost of an asset, it is necessary to distinguish whether it should be included in the statement of financial position in the cost of the asset or profit or loss as an expense. So, to include in the cost of an asset, expenditure that can be capitalized, that is included in the cost of asset, is incurred in the acquiring property and equipment intended for long-term use, that is, economic benefits are expected in future accounting periods, increasing the revenue uh, earning capacity of an existing non-current asset by increasing efficiency or useful life. Okay, the cost of an asset, except for the cost of land, will ultimately be expense to profit or loss, right? Such costs, which are the general in nature, will be expense. The depreciation, the cost related to assets, will also be expense and will go to these straight away to the health. That means to the profit or loss account as an expenses. Now, what are expenses? Expenses are incurred in daily running operations of the business. What are the examples? Examples are buying or manufacturing goods which are sold and providing services, selling and distribution goods, administration costs, repairing long-term assets. Repairing costs will be expense as well. These costs are expense to profit or loss as incurred. They are matched with the revenues of the accounting period. So far, so good. Uh, Now the example, for example, expenditure and expense examples. For example, you see a dollar 20,000 spent on acquiring a new car for a sales executive is an asset expenditure. An annual road or vehicle tax of 1,800 included in the purchase price of should be excluded from the cost of asset as it is an expense and it is a running cost, so it will go to the profit and loss account, while this will be included in the cost of asset. Okay. Dollar 10,000 spent on purchasing dollar 10,000 spent on purchasing a second hand delivery vehicle is asset expenditure that the purchase vehicle is now not new is irrelevant. Okay. Is irrelevant and it is included in the cost of asset. Okay. 12,000 spent on the reimbursement, that is renovation, or to bring it into use will also be part of the cost of an asset. That means it will be include into the cost of asset. Dollar 1,000 monthly rental for vehicle hire is an expense. Okay. And it will be expense into the profit and loss account. Now, the elements of cost, property, plant, and equipment is initially measured at cost. Cost including the following where relevant. Now, purchase price will include it into the cost of asset. Okay. Less trade discount. Trade discount will be deducted from the cost of an asset. Okay. Now the question is, what is the difference between trade discount and cash discount? For example, uh, it's you and you want went to a supplier to purchase certain assets. He said, buy 50,000 units. How much? 50,000. Buy 50,000 units, and I will give you 5% discount. 5% discount. That is straight discount, and it will be deducted from the cost of asset. Then we have second type of discount. Okay, that is straight discount. Now, another discount is cash discount. Now, what is cash discount? For example, we have a credit period of 60 days. Supplier said that buy the pay us in 10 days, and I will give you 2% extra discount. Okay. So this is cash discount, and it will not be deducted from the cost of asset. Okay, because even we are not sure either we're gonna avail this discount or not. So if we avail it, if it will be included in other income, and if we don't avail it, then nothing to do, right? I hope the concept is clear. So trade discount, as said, will be deducted from the cost of asset. Then add wages and salaries directly arising from construction of a asset, particular asset. Okay. Otherwise, if it is general, then it will be expense. Add cost of site preparation. Add initial delivery and handling cost. Add installation costs. Add professional fees. Add borrowing costs. Details about the borrowing costs will be covered in IS 23. Okay. Add decommissioning costs, or we also can it can also be said as dismantling costs. Now, what is dismantling cost? For example, here's a guy, and he goes to this land for the work of mining. Before starting the work, he got the paper from the government, and they said in which it was written that while you will be leaving, after you are done with your work, when you will be leaving, you have to bring asset into its original condition. Now, the question is, can we start the work without agreeing, without this agreement? No, we cannot, right? So, now suppose the work is of 5 years, and the cost we have to incur after 5 years is $10,000. So now we have to recognize this on the present value. On the present value, suppose today's present value is $2,000 every year. Interest is 10%. So every year we will add 10%. On year five, it will be 10,000. We will take out the 10,000 and we will pay them. So that's this decommissioning cost or dismantling cost. So I hope it is clear to you as well. Now, after that, all other costs which are necessary to bring asset into a working condition will also need to be capitalized. As far as self-constructed assets are concerned, the cost of self-constructed asset is determined using the same principles for an acquired asset. Any internal profits, example markups on material or labor, must be eliminated in arriving at the such cost. Similarly, the cost of abnormal waste of material, labor, or other resources is not included in the cost of asset. It will be expense into the profit and loss account. Okay. So interest must be recognized as a cost of self-constructed assets if recognition criteria are met, and it will be done as per the, as I said earlier, IS 23, which we will do later on. Now, expenditures recognized in the carrying amount of an item in the course of construction should be separately disclosed. Okay, it need to be disclosed. It need to be disclosed separately. That means you have to provide the disclosures separately. Depreciation of the self-constructed asset begins when it is available for use. As soon as it is available for use, start depreciating it. Now, we have the example. That is our activity one, construction cost. On 1st October 2006, Omega began the construction of a new factory. Costs relating to the factory incurred in the year ended 30th September 2007 are as follows. Purchase of the land, 10,000. Cost of dismantling existing structures on the site, 500. Purchase of materials to construct the factory, 6,000. Uh, Employment cost, 1,800. Production overheads directly related to the construction, we have to look at note 2, 1,200. Okay. Allocated general admin overhead, 600. Architects and construction fees directly related to the construction, 400. Cost of relocating staff who have worked at the new factory, 300. Okay. Uh, Cost relating to the formal opening of the factory, 200. Interest on loan to partially finance the construction of the factory, 1,200. Okay, so what is the note one? The factory was constructed in the 8 months. It was constructed in the 8 months ended 31st May 2007. It was brought into the use on 30th June 2007. The employment cost for the 9 months to 30th June 2007. Note 2, the production overheads were incurred in the 8 months ended 31st May 2007. They included an abnormal cost of 200,000 caused by the need to rectify damage resulting from a gas leak. Okay. So that is the abnormal cost. Okay. Uh, Abnormal cost, remember, it will be expensed and it will not be capitalized. Okay. Omega received the loan of 2 million on 1st October 2006. The loan carries a rate of interest of 10% per annum. So it is not sure, we are not sure by this note that it is specific to the asset or not. If it is specific to the asset, then it will be capitalized, and if not, it will be expensed. The factory has a useful life of 20 years, after which it will be demolished and the site returned to its original condition. The legal obligation arose on signing the contract to purchase the land. The expected of fulfilling this obligation is 2 million. An appropriate annual discount rate is 8%. The present value of $1 in 20 years' time is 21.5 cents. Okay, so complete the initial cost of factory. So let's start with it. Okay, although our solution with me uh, for this, but let me solve it for you. So, purchase of the site, I'm taking millions into thousands. Okay, so it's dollar 10,000. Dismantling cost, that's dismantling cost. So, purchase of the site 10,000. That will the cost include in the cost of purchase. Then dismantling cost, dollar 500. It's a site preparation cost, represent a direct cost, so it will be included in the cost of asset. Materials, materials, material cost, dollar 6,000. So all used in the constructing the factory, so it will be capitalized. Then we have employment cost. Mm, Employment cost. So the working is 1,800, and we are taking 8 months out of 9. for particular to this. So it's 1600. Then production overhead 1000. Now 1000, because abnormal cost must need to be accrued and excluded, and that 200, that normal cost was, so 1200 minus 200, the abnormal cost. So that's why I got 1000. Then admin overheads are the general one. They have to be occurred, no matter what. If this construction was not yet to be happened, still it has to be conducted. So, and we will, for to capitalize in the cost of the asset, only direct costs are allowed to be capitalized. So it's nil. Then architect fee 400, and it's a direct cost, so we will include it. Cost of relocating staff are not directly attributable to preparing the asset for use. So relocation cost nil. Cost of opening the factory, cost for opening asset, these costs are not included. The asset is already ready for use. So nil. Then we have capitalized interest, which is 12,000. The interest rate was 10%, and 8 months out of 12 was utilized, and it will be capitalized 800 as it is specific to the asset. Then restoration cost, that is the dismantling cost, will be capitalized. The rate was given 2 million into the interest rate on it, 2.215%, will get 430. So overall, total cost of factory is 10,000 plus 500 plus 6,000 plus 1,600 plus 1,000 plus 400, okay, plus 400, nil, nil, 800, 430. Overall, it is $20,730, which will be capitalized. Right. So far, so good. And I hope it is clear to you guys. Right. We have I also given you the much readable uh, solution over here as well. Now, as far as the measurements when where assets are exchanged with someone. So the cost is measured when asset is exchanged. In that case, the cost is measured as the fair value of the asset received, which is equal to the fair value of the asset given to the, for example, trade in for part exchange, adjusted by the amount of any cash or cash equivalents transferred, except when the exchange transaction selects commercial substance. Remember that. The fair value of the neither the asset received nor the asset given up is reliably measured. Whether an exchange transaction has commercial substance depends on the extent to which it is expected to change the reporting entity's future cash flows. Vehicles are commonly traded with the part exchange. Trade in some retailers and manufacturers also allow customers to trade in old items, for example, electronics, when purchasing new ones. Now, here it is. Hard Guys buys a new electric car for its sales director, having a list price of $92,500. The company pays 80,000 cash and trades in director's old petrol car. Required. Prepare the journal entries for the exchange. So let's do it now. Okay. So what's the cash payment for the uh, payment of the car? Well, motor vehicle debit 80,000, cash or you can say bank credit 80,000. Okay, this is the cash payment for the new car. However, the cash cost of the new car must be grossed up for the trade-in value of the old car. That is the disposal proceeds. Okay, so as far as the disposals are concerned, what we will do: motor vehicle debit dollar 12,500, credit 12,500. The disposal of the car is then treated in the normal way, right? And that is how. See, motor vehicle debit $92,500, cash credit 80,000, and credit disposals 12,500. So this is how it is done. Now, capitalization of subsequent costs. The issue in accounting for a subsequent cost is whether this should be categorized as asset expenditure or as an expense in profit and loss. So, for example, now what is subsequent cost? See over here. On this day, on year zero, we bought a asset for 100,000. Right? Suppose it has a life of 5 years. So each year depreciation is 20,000, right? Each year depreciation is 20,000. So first year depreciation 20,000. Second year depreciation 20,000. So here the net book value of the asset is 60,000, right? Now suppose here they incurred expense on it which of 20,000. They incurred expense of it on it of 20,000. And because of this expense, and because of this expense, if there is a number one, if there is increase in useful life of asset, there is an increase in efficiency of asset or decrease in operating cost of asset. If any of this thing happen, for example, at this date, this has it as a life of 3 years, right? And it becomes from 3 years, its life increased to 5 years or whatever it is, then it will be capitalized. Increase in efficiency means before it used to produce 5,000 units and now it's producing 10,000 units. Okay, decrease in operating cost means the electricity expenses or whatever expenses of the particular asset was, for example, 10,000 and now it's 6,000. So any of these conditions, if any of these conditions meets, then it's it's a this subsequent cost will be capitalized. If any of these conditions met, then the subsequent cost or the subsequent expenditure will be capitalized. Otherwise, straight away, it will be expense to statement of profit or loss, right? So now accounting for running costs. So the carrying amount of an item of property, plant, and equipment does not include the cost of the day-to-day servicing of the item. So servicing costs, for example, labor, consumables are recognized in profit or loss as incurred, it will be expense. Often described as repair and maintenance, running costs are made to restore or maintain future economic benefits of the assets, right? So now accounting for cost of power replacements. So, you know, sometimes example for those assets are aircrafts, ships, gas, turbines, etc. are the series of linked parts. They are also known as complex assets. Okay, for example, as I give you the example of various examples like aircraft, ships, gas turbines, etc. So, yeah, here it is. For example, this is airplane. Don't laugh on it. Otherwise, I will book a ticket for you in this aircraft for your next vacation, and you have to travel on. Okay, so you know, so sometimes, as I give you the example of aircraft ship gas turbines, and here is one of the aircraft. It has a series of linked parts. For example, the tail of the aircraft. This is the interior of the aircraft. This is the engine of the aircraft, right? This is the cockpit of the aircraft, and they all have, different useful lives. For example, cockpit have a life of, for example, 7 years. Tail have a life of 5 years. Engine has a life of 3 years. Okay. Uh, so by combining all of these linked parts, it becomes one asset. For example, the airplane. These are known as complex assets. Okay. Now here is the example as well. An airline is required by law to replace the engines or the aeroplanes every 5 years. For example, the engines may be identified asset with a separate line from the rest of the aeroplane and written off to zero over 5 years. After 5 years, engines will be replaced, and the cost of the new replacement engine will then be added to the cost of the aeroplane. This cost will then be depreciated over next 5 years, and the remainder of the airplane will be depreciated over the aeroplane's useful life, which will be longer than 5 years. This aeroplane is an example of complex asset, as I just explained. Okay. Now we have another activity. On 1st January 2002, Rooston Co. purchased an energy efficient furnace for $2,000. The estimated life of the furnace was 10 years, but its lining needed replacing after 5 years. On 1st January 2002, the management estimated that the cost of relining the furnace at 1st January 2002 prices was 50,000. The lining was replaced on 1st January 2007 at a cost of 70,000. So they require the annual depreciation expense on the furnace for the each year of its life. Okay. So, so far so good. And now let's do this example. So we are doing it for bit for the year 2000x2 to 2000x6 inclusive. Depreciation is calculated separately for two components. And what are the components? First, we have lining element, 50,000 divided by 5 years. So it's 10,000 per annum. Okay. The balance of the cost is the next dollar 150,000 divided by 10. It's 15,000. Therefore, the annual depreciation is 25,000. The overall annual depreciation 25,000 at 31st December 2006. The lining component has a carrying amount of zero from 2007. From 2007, uh, dollar 70,000 spent on new lining is treated as replacement of separate component. An asset and added to property, plant, and equipment. So the annual depreciation will now be how much? 29,000. How? See, 70,000 divided by 5 years plus 150,000 divided by 10 years. So it will be 29,000. So far, so good. And I hope it is clear to you. Now, accounting for major inspection or overall cost. So the major inspection for faults, regardless of whether parts are replaced, could be a condition for continuing uh, to operate an item of property, plant, and equipment, for example, a ship. Okay, on initial recognition, inspection costs are estimated. This amount is depreciated over the period to the first inspection. The amount is part of the original cost recognized and is not additional component of cost. On inspection, the inspection cost incurred at the point will be capitalized and depreciated over the period to the next major inspection. Any remaining carrying amount of the cost of the previous inspection as a distinct from physical part is de-recognized. The cost of each major inspection performed is recognized in the carrying amount as the replacement if the recognition criteria are satisfied. Okay. So a shipping company is required by law to bring all ships into the dry dock every 5 years, for example, uh, for a major inspection and overall expenditure might seem to be a repair to the ships. However, it is a mandatory cost incurred to keep the ships seaworthy, right? So therefore, the overall cost must be recognized as the part of ship's carrying amount. That means it will be capitalized. Okay. So, for example, a ship costs $20 million, has a 20 years useful life. The estimated cost of the first overall at the end of 5 years is 5 million. This may indicate the cost of overall component distinct from the physical parts when the ship was acquired. So the depreciation expense for the first 5 years of the ship's life is calculated as, overall cost 5 million. Physical it is 15 million. Years are 5 and here it is 20. So annual depreciation you can here see 1, but here it is 0.75. So total depreciation for the 5 years will be 8.75 and the carrying amount of the ship at the end of year 5 is 11.25 million. Okay, so the actual overhead costs incurred at the end of 5 years are 6 million because this subsequent cost will not be recognized in the cost of share to give a carrying amount of 17.25 million. And for the year 6 to 10, now again, cost 6 million. Here you can see, right? Years are 5. Annual depreciation, as you can see, 6 divided by 5, 1.2. Cost is, here you can say 11.5. The overall life is 15, so it is 0.75 again. Annual depreciation for 6 to 10 years is 1.95 million. How this process will repeat for 11 to 15, 16 to 20. By the end of year 20, the original cost of 20 million have been depreciated plus actual overhead cost incurred at the end of the year is 5, 10, and 15. Okay. Now, accounting policy for subsequent measure. An entity may choose between the two models. We have two models, that is cost model and the revaluation model. And the same policy must be applied to entire each class of property, plant, and equipment. That means if you choose straight line depreciation for the buildings, you have to apply on the same class the straight line. You choose reducing balance for the uh, machineries, apply reducing balance on each class, on entire class. So classes include land, land and buildings, factory, aircraft, vehicles, office equipments, fixtures and fittings, etc. Now the cost model. Under the cost model, asset is carried at cost less accumulated depreciation and any accumulated impairment. So it is cost less depreciation less impairment losses, if any. Okay. By the way, impairment losses will be covered in IS 36. Right. I hope you all know about the depreciation methods, that is straight line method and reducing balance method. But yeah, don't worry, we will revise them uh, in the same lecture. Okay. Now the second choice of the model is revaluation model. So under the revaluation model, assets are carried out at the fair value at the date of revaluation, less any subsequent accumulated depreciation and any accumulated impairment losses. So all revalued assets except for land are still depreciated. Okay. Fair value and the revaluation model, only those assets which whose fair value can be measured reliably may be revalued only. Remember that. Remember that those assets which whose fair value can be measured only those can be revalued. Okay. Now we have four cases of revaluation. Okay. We have four cases of revaluation. Case number one, first time upward revaluation. First time, upward revaluation. Now, for example, on year zero, we bought the asset for 1,000. So, what will be our entry? Asset debit 1,000, right? And cash, or you can say bank credit 1,000. Now, at the end of the year one, its value is 1,500. So, assets value increased by 500. So, that's why asset debit 500. Now, the question is, if we have sold the asset yet? No. So, do we realize the gain yet? No. So, uh, the gain is not realized yet. We have we in actual we didn't get the realize the gain. It's actually just a increase of property uh, fair value increase. So we cannot recognize as an income into our income statement, right? As per the prudence concept. So we will recognize it the gain in equity, and equity there is a reserve known as the revaluation reserve. So when equity goes up, it gets credited. So revaluation reserve credit 500, right? I hope it is clear. The case number one. Then we have second case. First time downward. Uh-oh. Yeah. So on year zero, asset value is 1,000. We purchase it for 1,000. So like before, it is same asset debit, uh, 500. Oh, sorry, 1,000, and cash credit 1,000. And at the end of year one, now its values goes down to 750 from 1,000. So asset value is credit by 250. Now, as the values goes down by 250, we will recognize the expense to the profit and loss account as an expense 250. Now there is a boy in the class. So when the values goes up, you recognize the gain in the equity. And now you are recognizing it as an expense. Why? I said it is the application of prudence concept. And prudence concept says that you cannot recognize the gain as an income into the profit and loss account until or unless you actually recognize it. But when you foresee some expenditure, do recognize as an expense into the income statement immediately. So that's the application which we applied over here. I hope case two is also clear. Now the case three. First upward, then downward. Okay. Here we are. Year zero, year one, year two. So in year zero, we bought the asset for 1,000. On year one, its value goes up to 1,500. And in year two, its value goes down to 750. So when we purchase the asset on year zero, we all know what it will be: asset debit 1,000, cash credit 1,000. When its value goes up, it's just like a case number one: asset debit, 500, revaluation reserve credit 500. Right? So now in year two, when its values going down from how much? From 1,500 to 750. So asset will be credited by 750. Now the question is, how much revaluation, how much we have recognized in the revaluation so far? 500, right? So we will finish it off, and to finish it off, what we have to do? We have to debit revaluation reserve by 500. Now how much is remaining? How much is remaining? 250. So where it will go? It will go to profit and loss account. So we will recognize it as expense. So P&L account, profit and loss account will be debit by 250. I hope case 3 is also clear. Then the final case. First downward, then upward. Year zero, year one, and year two. So on year zero, it's 1,000. On year one, its value is now 750, and it's 1,500. So when we bought the asset on year zero, it is, yes, repeat with me: asset, debit, how much? 1,000. Cash, credit, how much? 1,000. 750. Now, at the end of year one, it is just like case number two. So, profit and loss account, debit 250, asset credit 250. Now, from 750, its value going up to 1,500. That means the asset value is increasing by how much? 750. So asset debit 750. How much expense we had recognized so far? 250. So we will finish it off, we will reverse it, and it will be now, sorry, It will be now profit and loss account will be credit when we will reverse it 250. How much is remaining now? 500. So it will go through the revaluation reserve. And when revaluation reserve increases, it will get credit, right? So it is credit 500. So I hope case number 4 is also clear to you guys. As far as the frequency of the revaluation is concerned, revaluation must be made sufficiently regularly to ensure that there is no material difference between the carrying amount and the fair value at the reporting date. The frequency depends on movement in fair values in the particular market. A further revaluation is necessary when fair value differs materially from carrying amount. Items in class may be revalued on a rolling basis within a short period, provided that revaluations are kept up to date. Okay. Now, as far as the accumulated depreciation on the revaluation assets are concerned, um, at the date of revaluation, accumulated depreciation is either restated proportionally when the change is in grossing carrying amount, so that in the carrying amount after the revaluation equals its revalued amount, or eliminated against gross carrying amount and net amount restored into the revaluation amount. So here it is, the another example for you. Yeah, just a second. An entity adopted the revaluation model for property, plant and property on 1st January 2006 when the carrying amount of its property was cost 800. As you can see, accumulated depreciation is 200, so the carrying amount is 600. The fair value of the property was 950,000. So here it is, as you can see. Uh, Cost 800, adjustment made was 150. So the after evaluation, its value is now 950. Accumulated depreciation was 200. What is accumulated depreciation? The depreciation which we have deducted so far in previous years. So to adjust it, as we have to write it off 200. Now after evaluation, it's zero. Now the carrying amount you can see is 600, and now we'll make the readjustment of 350. That's how we will do it. Okay. Uh, Adjustment of 350 we had made, and after evaluation now its value is 950. So now when its value is 950, okay, now the asset will be depreciated on its revalued amount over its useful life. Whatever the life is remaining, it will depreciate on. Okay. So where to how to do the recognition of revaluation? An increase or decrease in carrying amount as a result of revaluation is accounted for on an asset by an asset basis. Okay. A revaluation is credited to the other comprehensive income and transferred to the revaluation reserve. Surplus or reserve is the same thing in equity. A revaluation increase, however, must be recognized in profit or loss to the extent that if reverses a revaluation decrease previously recognized as an expense and impairment, okay, a revaluation decrease is recognized as an expense in profit or loss for the period and impairment. A revaluation decrease, however, must be recognized in other comprehensive income to the extent that there is a revaluation surplus relating to the specific asset. Any amounts recognized in profit or loss are represented in the operating category. Okay. Amounts recognized in OCI are presented as OCI that will not be classified to profit or loss. Okay. So let's do the example on it. The activity cost 1000 accumulated depreciation, 250 carrying amount, 750. So determine the accounting entries required to restate the net amount at a revalued amount of 1100 and 900. So, so good. Let's do this. Yeah. So first, a part in which our cost is $1,100. Now, the accumulated depreciation after the revaluation is zero. So, carrying amount of the asset will be 1100. For this, our entry will be cost is cost of the asset increasing by 100 from 1000 to 1100, right? Accumulated depreciation, we have to write it off. We have to destroy the accumulated depreciation. So it will be debit by 250. And how much will go to the revaluation surplus? So revaluation surplus will be credited by 350. So far, so good. Then we have part B. Here, the cost of the asset is 900. Accumulated depreciation after the revaluation incurs, it's zero. So the carrying amount of the asset is 900. Now, accumulated depreciation is 250. Cost is 100. And revaluation surplus is credit by 150. So far, so good. I hope it is clear to you over here till here. So now the examples. An entity purchased land for 100,000 on 1st January 2000X1. The entity adopts the revaluation model for land. Okay, as you can see, 1st January 2000X1, asset cost was 100. Now revaluation surplus SC is credit by 20 is credit. So the initial gain is recognized in other comprehensive income in the profit and loss account, in the statement of profit or loss, and accumulated in revaluation surplus in SOFP in statement of financial position on 1st January 2000X2. Suppose now the asset value was for 120. Now its value is decreasing by 15. Its closing value is 15. So from revaluation surplus, we will debit 15. We will deduct revaluation surplus by 15. And the balance of the revaluation surplus will be 5 credit. So a decrease in recognized in profit or loss unless as that it reveals a revaluation surplus in relation to the asset, right? Now, another example over here, you can see that on 1st January 2000X3, its value is now the 105. Further, its value has decreased by 9. Now, the carrying amount of the asset is 96. So, what we will do, we will write off remaining 5 from the revaluation surplus, and other 4 will be expensed into the profit and loss account. So again, the decrease in recognized in OCI, but only to the extent of the credit balance on the revaluation surplus. The excess is recognized as an expense in the profit or loss. See, Then again, now the next year, 1st January 2004, the opening value of the asset, net book value of the asset is 96. And now its value has increased by 15. The closing value of the asset is 15. So what we will do, 11 will be credited. Okay. So the part of the increase that the reverse the previously recognized expense in profit and loss, the excess is again recognized in OCI and accumulated in revaluation surplus. So in the case of a depreciating asset, depreciation should be recognized each year before the revaluation adjustment. So first you will recognize the depreciation and then you will perform the revaluation adjustment. Okay. I hope it is clear till here. Now, Rosette Company purchased a building on 1st April 2001 for 100,000. The asset had a useful life of that date of 40 years. On the 1st April 2003, the directors revalued the building to its fair value of 120,000, calculate the revaluation gain, and prepare the journal entry to account for the revaluation. So far, so good, and I hope it is clear till here now. So, carrying value, or you can say carrying amount at revaluation date 100 divided by 40 years into 2 years, we get 95. The fair value of the asset is now 120. So, the gain on revaluation is 25. So, what will be our entry? Double entry is building cost, that is 120 minus 100, it's 20. Okay. Accumulated depreciation, we will be write off by 100 into 2 years already gone divided by 40, it's 5. Okay. And credit OCI, or you can say revaluation surplus, will be credited by 25. So that's how it will be done. Right. I hope it is clear till here. Now we have the activity, the carrying amount of Zen company property at the end of the year uh, amounted to 108,000. Cost value 125,000 and accumulated depreciation 17,000. On this date, the property was revalued and was deemed to have a fair value of 95,000. The balance on the revaluation surplus relating to the previous revaluation gain for this property was 10,000. So calculate the revaluation loss and prepare the journal entry to account for the revaluation. Uh, so carrying amount of property at revaluation date 125 minus 17. How much we got? 108. Fair value 95. So now the loss on revaluation is 13. So what will be the entry? What will be the entry? Property value is goes decreased by 13. 13 into 100. 100 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 into 30,000. So it's 30. So it will be credited. Accumulated depreciation, debit accumulated depreciation by 17. The impairment loss they had provided us already. So it's an expense, right? And for now, impairment debit by 3. How much is remaining? 10. So it will goes to the OCI by 10. That's how you will do. So the 10,000 evaluation decrease debited to OCI is transferred to the reduce the balance on the revaluation in the statement of financial position. It is presented as a movement in the revaluation surplus in the statement of changes in equity. To adjust the carrying amount to the revalued amount, the accumulated depreciation is eliminated against the gross carrying amount of the asset at the revaluation date. Now, subsequent accounting for the revaluation asset, revalued asset. So their depreciation after the revaluation increase or decrease is recognized, an asset continues to be depreciated over its useful life. The result this will result in higher annual depreciation expense that the based on the historical cost where the revalued amount is greater than historical cost carrying amount and lower annual depreciation expense that based on historical cost where the revalued amount is less than the historical cost carrying amount. Simple. We did the both type of examples. Okay. When values goes up, obviously the expense of the depreciation will be higher. When the values goes down after the revaluation, the depreciation will be lower. Now the next thing, where the revalued assets carrying amount exceeds the historical carrying amount. So IS 16 allows, but does not require, it allows an entity to transfer the depreciated expense as a result of the revaluation uh, from the revalued surplus to the retainer. Uh, Sorry for that. Any transfers to the retained earnings is made with an equity and disclosed in the statement of changes in equity. Oh, God forbid from this flu, by the way. Uh, okay, now example 8, as you can see, statements of changes in equity. Balance at 31st December 2006. We have the share capital opening amount, share premium opening amount, revaluation surplus, retain earning, issuance of share capital, share premium, and the total amounts. Okay. So dividends paid and declared, if there is any, will be deducted from retained earning. Uh, Income for the year, increase or decrease, it will come in retained earning as well. Transfer to retained earnings, such as the revaluation surplus, will come here, right? And then we will get the year-end balances. So far, so good. I hope it's all clear to you. Really good. So the transfer is the difference between the annual depreciation expense based on the revalued amount and the annual depreciation expense. based on the historical cost. It represents the realization of the revaluation surplus through the use of the asset, and it means that retained earnings are not reduced as a result of decision to adopt the revalued model. The transfer is made annually. Let's do the example. Hair company revalued its property on 1st April 2000 to 20 million, 8 million of which related to land. The property originally cost 10 million, 2 million of which related to land. 10 years ago, the original useful life of 40 years for the building is unchanged. Here's company policy is to make the transfer to retain earnings in respect to of excess depreciation. Now the requirement is show the journal entries required to account for this property during the year ended 31st March 2000 X2. Prepare extracts from the following financial statements for the year ended 31st March 2000 X2, statement of profit or loss for the comprehensive income statement of financial position, statement of changes in equity. So let's start with it. Now, firstly, what we will do? We will do our workings. Uh, First working is on gain on revaluation. So carrying amount of property at revaluation date. It's 10,000 minus 2,000 previous depreciation divided by 40 years and the whole life and the 10 years the asset has used already. So we got 8,000. Fair value of the asset is now 20,000. So the gain on revaluation is 12,000. Now, reserve transfer, historical depreciation, 10,000 minus 2,000 divided by 40, we got 200. Depreciation on revalued asset is 400. So excess depreciation, excess depreciation to transferred is obviously 200. Okay. Uh, so gain on revaluation. Now what will be our double entries over here on gain on revaluation? It's property debit by 20,000 minus 10,000. So it's 10,000 debit, right? Uh, Property accumulated depreciation as per the working we did over here. Let me repeat it for you. 20,000 minus the 2,000 divided by 40-year life into the 10, we got 2000. So it will accumulated depreciation write-off 2000. Revaluation surplus will be credited. We already done the working above 12,000. Next is the depreciation charge double entry is depreciation expense 20,000 minus 8,000 divided by 30 years life is 400, and property credit 400, their accumulated depreciation back. Then for reserve transfer, revaluation surplus debit 200, and retain earning credit 200. So far, so good. See, here it is. Now the extracts, as you can see. Now the extracts you can see from the statement of profit or loss, the depreciation expense recognized as an expense over here, right? Other comprehensive income. In other comprehensive income, the gain on property revaluation will come over here. Then we have non-current assets, property 12,000 minus 400, 19,600. In equity, revaluation surplus 12,000 minus 200, 11,800. Then statement of changes in equity extract, we have, okay, gain on revaluation. In revaluation surplus column, we got it here, okay. In revaluations transfer minus 200, that is the excess depreciation, is transfer like that. That's how we will do it, okay. So, when a revalued asset is disposed of, any remaining balance on the revaluation surplus may be transferred directly to the retained earnings. The disposal represents the realization of this surplus. Okay. As far as the depreciation of property, plant, and equipment is concerned, now here it's the our sort of a revision now. Uh, a depreciable amount of an asset cost of revalued amount less residual value is allocated on a systematic basis over the useful life of the asset. The depreciation method should reflect the pattern in which the economic benefits are consumed. So depreciation expense for each period is recognized in profit and loss account as an expense. It is included in the carrying amount of another asset, for example, in inventory. Depreciation expenses are presented in the operating category in the statement of profit or loss. Okay, it will be recognized in the operating category of profit or loss statement. Each part of an item of property, plant, and equipment which is significant to total cost is depreciated separately. So the depreciable amount of an asset, cost or revalued amount less residual value is allocated on a systematic basis over the useful life of the asset. Okay. The depreciation method should reflect the pattern in which economic benefits are consumed. The depreciation expense for each period is recognized in P&L, profit and loss, unless it is included in the carrying amount of another asset. Depreciation expenses are presented in the operating category in the statement of profit or loss. Okay, operating category. Now, each part of an item of property, plant, equipment is significant to total cost is depreciated separately. Now, accounting estimates. Okay, as far as the depreciation methods are concerned, we have straight line method. So for straight line method, it is cost less residual value divided by useful life. For example, the cost of the asset is 100,000 minus residual value is 20,000. The life is 4 years. So how much it will be? How much it will be? See, 100,000 minus 20,000, the residual value, divided the life. Oh, so 100,000 minus 20,000. 80,000, right? So 80,000 divided by 4. 20,000 is our per annum depreciation of an asset. Uh, Straight line method assumes that every year asset has a same pattern of usage, same sort of a usage. Every year it will give equal benefits. So every year it recognize the same expense. Right? So far, so good. Then we have the reducing balance method. So for reducing balance method, what we will do, for example, the cost of an asset is 100,000. Depreciation percentage is 20%. So that means 20,000. Next year, its net book value is 80,000. Again, the depreciation is 20%. So it's 16,000. Now the net book value is 80,000 minus 16,000. 64,000, right? So 64,000 into 20%, 12,800. Oh, sorry. Yes, 64,000 here. This year, depreciation 20%, 12,800. And now the net book value is how much? 64,000 minus 12,800. 51,200. 51,200. So what it's doing actually, see over here. Earlier, it's the higher depreciation, then it's getting lower. Then again, it's getting lower. See, lower and lower. So what it assumes that in earlier year, asset is giving more benefit, and the later years, it's giving less benefits. And see the application. You can see the application over here. That's how it works. That's the reducing balance method. Okay. So, so far, so good. And I hope it is clear till here to you guys. So, accounting estimates, the residual value, the useful life, depreciation methods are all accounting estimates. Residual value. of an asset is the estimated amount that entity would currently obtained from the disposal of the asset after deducting the estimated cost of the disposal. If the asset were already of the age and in the condition expected, the end of its useful life, this may be the scrap or second hand value, or it may be nil. So that's the residual value. Okay, then depreciation methods. Uh, so as far as the depreciation methods are concerned, we already discussed the most common depreciation method. We already discussed straight line method, reducing or balance method. It is also known as diminishing balance, that is decreasing charge over useful life. Then units of production method is one of the method, that is the charge based on expected use or output. It will be based on the output, how much output has occurred during the year. So the method should be reviewed annually. Change will be reflected in the depreciation expense, in the profit or loss, in the current and future periods. Okay. So depreciation period starts when an asset is available for use and ceases when asset is de-recognized, examples scrapped or sold or classified as held for sale. Now let us do another example. An asset costing 1000 was estimated to have a useful life of 10 years and a residual value of 200. After 2 years, the remaining life was revised for 4 years. Calculate the depreciation expense for each of the first 3 years. So very simple. Cost year one. Okay, it's year one. It's year two. It's year three. Okay. Cost 1000, 1000, and 1000. Accumulated depreciation 80, 160, and 320. So the carrying amount is 920. It's 840, and it's 680. Expense for the year, you can see expense for the year 80, 80, and then 160. So depreciation of land and buildings. Uh, Land and buildings are separable assets and are dealt with separately for accounting purposes, even they are acquired together. So land usually has an unlimited useful life and is therefore not depreciated, right? It will be not depreciated. Whereas buildings typically have a limited useful life and are depreciating assets. Okay. Now another activity. A company purchase a property with an overall cost of 100 million on 1st April 2001. The separate components of the property are made up as follows. Okay, land, buildings, land element is 65,000, uh, which is indefinite. Building life is 50 years. Fixture and fittings 24,000. Lifts are 11,000. The lives are given respectively. So calculate the depreciation expense for the property for the year ended 31st March 2002. So what will we do? Land and building, 65,000 minus 20,000 divided by 50. We got 900. Fixture and fittings, 24,000 divided by 10, 2,400. Lifts, 11,000 divided by 20, 550. Total property depreciation, 3,850. So, non-depreciation of property, plant and equipment, there is an argument that certain assets should not be subject to general rule that all assets must be depreciated. In some jurisdictions, countries, companies have adopted a policy not to depreciate certain assets. So, the argument for non-depreciation are assets are maintained to a very high standard. As this maintained causes expense to profit or loss, depreciation should not be charged as well. So the residual value is at least equal to the carrying amount that is due to high maintenance, and asset have a very long useful life such that depreciation is immaterial. The asset is not currently in use. Okay. So remember, IS 16 land that is not consumed is not depreciated. Depreciation must be recognized in all other circumstances, but may be zero, where the residual value exceeds the carrying amount of the assets. As far as the impairment of property, plant and is concerned, equipment is concerned, the recognition and measurement of impairment losses is accounted for accordance with IS 36, and we will study it later on. Okay, we will do it. Then we have compensation. In certain circumstances, a third party will compensate an entity for an impairment loss, for example, insurance for fire damage, compensation for compulsory purchase of the land for motorway. Such compensation must be included in property or loss. It becomes receivable. A recognized compensation as deferred income or deducting from the impairment loss of the cost of a new asset is not appropriate. So, as far as the accounting for derecognition of property, plant, and equipment is concerned, non-current asset is derecognized as follows. Statement of financial position, eliminate the assets carrying amount on the disposal or when no future economic benefits are expected from use, that is the retirement. In profit and loss account, in the statement of profit or loss, recognize a gain or loss difference between estimated net disposal proceeds and carrying amount unless transaction is sale and lease back. Okay, so for that we will do IFRS 16. Gains are not classified as revenue and should be presented in the operating category of statement of profit or loss. And for that we will do IFRS 5 for treatment of non-current assets held for sale. Now, derecognition date, as far as the derecognition date is concerned, the derecognition date is the date the recipient takes control of the asset, assuming all the performance obligation according to the IFRS 15 contract with customers, revenue from contract with customer has been made. So let's do one more activity. An asset that originally cost 16,000 had accumulated depreciation of 8,000 was had a disposal 8,000 was disposal of the during the year for 5,000 cash required. Explain the disposal should be accounted for in the financial statements. So far so good. So the asset, remember, the asset and its associated accumulated depreciation should be removed from the statement of financial position, and the loss of 3,000 should be recognized in the operating category in the statement of profit or loss or disposal proceed. 5,000. Carrying amount at disposal is 16,000 minus 8,000. 8,000. Loss on disposal, 3,000. Okay. So it will be recognized in the operating category of statement of profit or loss. Okay. So far, so good. I hope it is clear till here. Now, what are the disposals required or disclosures required? Disclosures required for each class of an asset. So, firstly, the following disclosures are required for each class of asset measurement basis used for determining the gross amount, depreciation methods used, useful lives or the depreciation rates used, gross carrying amount and accumulated depreciation and impairment losses. The following disclosures are required for each class of asset measurement basis used for determining the gross carrying amount, depreciation methods used, useful life or the depreciation rates used, gross carrying amount, and accumulated depreciation and impairment losses. What other disclosures are required? Other disclosures include existence and amounts of restrictions on title, property, plant, and equipment pledged as security, if there is any, expenditures recognized in carrying amount of an item of property, plant, and equipment in the course of its construction, contractual commitments for the acquisition of property, plant, and equipment, compensation from third parties, items, impaired, loss of given up, which is included in statement of profit or loss if not disclosed separately in profit or loss. So this is our IAS 16, and I hope it is clear to you all. Uh, Yeah, and finally, if you guys have any questions or you know, you can contact me on my WhatsApp, which is +920 302 177 7706. This is my WhatsApp. That's it.